All right, what's up, guys? So for those that are new, we're starting to do these 30-minute, very concise, just portfolio reviews. We go through what each one of the individual trades are, a little bit of the background on them. For those, kind of the thesis of this channel is that option trading is like riding a bike. So what does that mean? It means that you can watch all the tutorials that you want on riding bikes, and at the end of the day, you're gonna have to get on one. And that's kind of the same idea with trading. You just got to jump in, start with small trades that you're comfortable with and scale from there, and kind of develop a sixth sense, if you will, on trading. And I'm here to help you through that process. I've been trading for a couple years now, 4 or 5 years. I am personally on a personal level. I sell commercial real estate, so financials is as the market is something that I'm very in tune with. So those that have been here before or know me from Twitter, from X, go ahead and follow me there. Snowball Hustle, same thing as my YouTube. All right, so let's go ahead and dive in. I'm gonna go ahead and share my screen. Okay. Uh, Let me real quick. Okay, cool. Okay. All right, so I'm gonna go ahead and share my screen. I'm gonna do Robinhood. So I use Robinhood for my primary, just because it's the easiest to understand, and they do a very good job at it. Just bear with me 1 second. Probably shouldn't be one. Let me log in real quick here. Okay. I usually don't use it on my computer. I mainly use it on my phone. So so Robinhood's freaking out here that it's being accessed from another place. So all right, so let's go ahead and share the portfolio one more time. All right, well, that's not the account. Give me 1 second. All right, so now you guys can see my screen. This is the account that I opened with, I believe it was $130,000. I funded it year to date. We're up close to 32%. So the idea with this account is to eventually grow it to obviously $1 million. That's going to take a couple years, but consistent and very safe trades will get you there. That's why I love option selling. I think we're all here for the same reasons. I'll do another video on option selling another day. So to keep this 30 minutes, let's go ahead and dive in. Everybody can see my screen. Let me dive in and just kind of set the stage on where my trades are at. And then we can, with the Q&A process, we can go ahead and open them. So I have 2 American Airlines puts. I opened up an 11 and a 10.5. I think right now American Airlines is trading at $10.58. So look, right now this $10.50, obviously there's risk there, considering that it's very close to the strike. But considering we're going into the summertime when traditionally airlines outperform, American Airlines did not get caught up in the whole CrowdStrike issue, much like Delta did, but it obviously is feeling a lot of the repercussions. If you look at the 3-month chart, not great. It's kind of on a downward trend, but it does seem to have a pretty solid kind of support around this area. Let's look at the year one. So in 2003, October, got all the way down to 1092. So it did break this kind of support from October 26, 2023. Look, the graph does not look great, but what we do know is American Airlines is always rescued if it gets into financial trouble by the government. It's an essential company. It's essential for the operation of when you talk about national security. So it's a safe stock in my eyes. Look, we're going into, would I play this stock after summer? Probably not. But I think the premium right now for a decent position, 20 sells at, what is that, 1,050? That's like $20,000. So it's not a big position, but the premium is very attractive. Right? So the way I look at these premiums is, I look at, what are we looking at? We got the average credit of 35.50. So 35.50 and a collateral amount of $1,000.50, times 100. You're looking at a 3.5% return on premium in a week. So obviously, you're gonna have some strength. You could play these a little further out, maybe the $10. But look, I feel safe with this position. I like it. I like the premium. I like what I'm receiving for my risk. These $11 ones, I'll probably just roll down, and I'm not extremely concerned. This one right here, truthfully, I started this position because I follow, I'm a big fan of TJ the Wheel Deal. I think his approach is phenomenal. He plays this one a lot. Obviously, it's very volatile, which obviously the premium is equally enticing. And so I opened a very small position. I bought, what I like to do is I buy one share and then I track it over a couple weeks just to get a feeling for, stocks trade in they all have their own trading way styles, and they get caught in these cycles, in these short-term cycles, and they're very repetitive until they either break out or they don't break out. So I like to track it, and I've been tracking this company for a while now. I decided to open up two cash secured puts. So I've got I opened up the 1750. Right now we're pretty much at the money. So these are probably, I'm gonna have to probably roll these out. But again, I'm not entirely concerned on rolling these. These expire on the 26th, so at the end of this week. I got $62 per contract. So this is even crazier. When you look at $62 or did I get 62? Yes, I got $62 with a collateral of 1750. You're talking about 3.5. So it's very similar to American Airlines. This obviously reflects a lot of what Bitcoin is doing. So you have a pretty good understanding of the crypto market, specifically Bitcoin. So just something to keep in mind. Probably won't do more than those positions just because of how volatile, and truthfully, I'm not very familiar with the company. So I'm just going to keep an eye on this. So next one is Melly. Melly is a very interesting company because it's pretty much the Amazon of Latin America. Okay. It's performed spectacularly the past couple years. You look at the stock ratings from Morningstar, and so the company's called Mercado Libre. It is based in America. It targets Argentina, Brazil, Mexico. Pretty big, 60,000 employees. It's essentially the Amazon of Latin America. Now it is trading at a higher PE just because of the implied growth that it may have. Amazon is still a growth company, quote unquote, but their software side is kind of taking its own legs, and the Amazon side of the business is not as aggressively growing. So my point in saying that is that this company has a lot of expected growth in the next couple months. So they have earnings on the 31st. These are one of the very few kind of, I don't want to call them lottery tickets, but these are definitely my high risk plays. These particular trades, they're high risk because I usually don't buy calls. And whenever I do buy calls, I buy them a bit in the money and then long dated, so that way I can sell calls again against them until I want whatever event that I'm looking at happens. And so with this particular option, I bought the 1680 option for I paid $10,600 for one option. And the idea is that when they report earnings at the end of this month, there's going to be a stock split announced, which should drive the stock further up. Again, very hypothetical. It's a risk I'm willing to take, not something I would recommend if it's a large part of your portfolio. And so what I've been doing is I've been selling calls against this call. So it's essentially what you call a poor man's covered call, short dated calls, in order to just kind of recover a bit of my premium that I paid, just in case, it does. There is no split and the stock price holds. That's why I bought it till 8/16. So I have 2 weeks left of time essentially that I bought to either dispose of it or see what I do. But anyway, so I bought this 1680 call, and right now I currently sold at the beginning of the week a 1700 one. Now this one is, when I sold it, it wasn't as close to the money as it is now. Obviously, I'm down on it $800. I'm not concerned. I don't think Melly's gonna do much until we get closer to earnings. I think everything's pretty much priced in. I think much like Nvidia, when there was a stock split, the increase happens post split just due to the buyer pool and the smaller position size that's required to buy shares. It just opens up the pool to buyers, and that's where you traditionally see that additional kind of squeeze. But the past week has been pretty stable. I don't think it's going to go over 1700, and if it does, I'll roll it out, or I'll just buy it. Or I can roll it out to a strike price of 1750 or 17 or 1800, whatever it is, and just let it expire along with my other call. Which by that time, the call, since it's pretty much in the money, you're also taking advantage of that cost. So, one of these days, what I'll do is I'll focus strictly on that poor man's covered call, and we'll really go into the math. TJ the Wheel Deal does a great job at kind of explaining those, and his portfolio leans a lot that side, which is, look, it's a different strategy, but it's obviously worked for him. All right, Melly, let's keep this going. It's already 12:41, so it's 10 minutes in. So I want to keep this to like 5 more minutes, and then we'll do a Q&A. Palantir was just a strict, wheel strategy. That's pretty much how this has gone. Just a very bread and butter, do the option wheel on it. What I did was I opened a position by buying shares. So traditionally, you would start a position by selling puts, right? And then getting assigned and then turning around and selling the calls. I dove in. I like the stock. I like Palantir. I follow the founders very closely, Peter Thiel, Alex Karp. I think they're phenomenal guys. And I think that as warfare transitions into more AI-based and more information-based rather than actual ammunition, I think companies like Palantir are going to be they're basically going to be the new oil in the war machine. Whether you hate it or you love it, it's going to happen regardless. So you might as well profit from it. The war machine in the U.S. is probably one of the most I don't want to say important, but it's probably the largest source of funds that from public funds that go to private funds. Because look, who's going to trust the government with developing an AI? They wouldn't do it in 100 years. So they have to really source this money to the private market. And I think Palantir, with their contracts, it's that industry is very sticky. Once you get in through the front door of the defense industry, as long as you perform, you're pretty much, you're going to stay and get a lot of those federal dollars. And I think Palantir's positioned themselves perfectly. So I bought in at an average cost of $27.84. I went ahead and turned around and sold a $28.50 call, which I was in the money on. So then I rolled it to a $29 call. So I rolled it up and out, right? And this is expiring August 2nd. So I'm not concerned about this at all, to be honest. I might even let it go if it gets to 29. I'd like to hold on to my shares. I really would. But it's just something I'm tracking, doing pretty good on that. I wish I would have done a bigger position size. Snow. Now, Snow is one of those where it's gotten completely beat up. Snow has gotten completely beat up. I think it's a very strong company. It has a very good value proposition when it comes to kind of their data warehousing offering, data cloud. I think ever since the CEO kind of stepped down and the new one came, Sridhar Ramaswamy, when he recently became CEO, I think they're positioned to do very well, but the stock is just on a very downward trend. You look at the rates here, you've got 70% buy, research report, fair values at 187. So my point is that I feel comfortable taking this risk. And so I sold 136 puts, and it obviously was in the money drastically. It was like a 132. So I rolled them down to 135. And then the stock kept going down. It's like at 132. And look, this is a very good kind of example of, while there are risks in selling puts, as long as the stock doesn't get away from you ridiculously, I'm talking 10, 20, 30%, with time, there's always a chance for you to repair the trade. And that's the idea, for you to repair these trades so that, ideally every trade is profitable, or the highest percentage of trades. And so this particular stock, because it is so volatile and there is a lot of premium, if you do choose to roll it out, that IV helps a lot in making it a credit, not a debit roll, which I always like to roll for credits. It's just one of my rules. I like to do it. I always like to make money in everything I do, so I roll for a credit. This one I rolled it for 617. It's at, price is at 378. Obviously, my break even is a little bit lower than this. So if I'm not mistaken, and I'll bring up my Excel next time, I think my break-even price is 150 per contract. So even at this, because I rolled it, whenever you roll, you have to keep track of, what premium you got in the beginning. So that way, what your break-even is as far as premiums, because you don't always have to hold it to zero. You can close it early. If you really want to get out of the trade, you can close it early. But as long as you keep track of what your break-even, what price this contract has to get to in order for you to close, right? So while it does shut them up $717, that's not really true, because I also lost money on the rolling part of it, right? So that's something that I may also cover if enough people want me to go through, as how to keep track of that premium as you roll, in order to make sure you have that break even very, very, top of mind. So what will I do with this? I'll probably just keep rolling it down, to be honest with you. Keep rolling it from 135. I'll probably go down to 134. Just kind of keep accumulating that premium, and then until eventually I'm out of the money again, and it expires at zero. I'm willing to do that. All right, let's keep going. So snow, what else do we have? And so the 99% of my portfolio is in Tesla. I'll give you a quick story, and this is something that's more on your own strategy, but there's really two ways when it goes to option selling. And as your portfolio grows, it'll change. You look at YouTubers like Invest with Henry, who is, I think one of the OGs here, phenomenal guy. I think his content is amazing. He has a majority of his portfolio in Apple, but then he also does a lot of different companies, American Airlines. He really diversifies, Amazon, and that's good. You should be diversifying. At the end of the day, though, it gets a little bit too much if it's too big of a portfolio size. So you invest in either a SPY or a QQQ or an Apple, or one of these big companies that's stable. But one of the main paradigm shifts that I kind of went through as a trader was, instead of picking and choosing a bunch of different stocks and not really being familiar with them on a very deep personal level and getting to know the stock and what it's doing, I really came to like what TJ Wheel Deal does, which is, you pick your horses, 3-4 horses for, a year, 2 years, or until you lose faith in them, or whatever the conclusion is. But you ride the horse for a long period of time, because selling options is not always green. There's moments where you're below what you paid for the stock, but those are the moments where you're accumulating premium, right? You're accumulating premium. So when your stock price goes back to what you bought it at, it's not going to be a 5%, gain. It's going to be a 15 or 20% gain, because you've been accumulating that cushion of premium, right? And that's something you can only do if you're riding the horses of these stocks, because if not, you're just chasing the shiny object, and that's never good for options, And you shouldn't also just chase premium. You should really like what you're writing calls on and puts on, and get familiar with the way it moves and how it reacts to certain news. Some people know, and the majority of the times are right, just how stock reacts after earnings, or whatever the instance is. My point is that you should pick stocks that you're willing to ride for a couple of years, and really just hone in on wheeling those. That's one of the best tips that I got. Tesla is that for me. So I'll tell you the quick story on Tesla. I got about 900 shares when it came to Tesla at around 172, 173. Truthfully, I started buying at like 180, and then I just averaged down as it kept going. So I bought shares in the 140s, the 180s. My average is 172. I bought 900 shares, and then I also bought. I had bought a few calls, but I just as a strategy, I would sell them off as Tesla would keep going up and up and up. This is the last one I held on to, and I held on to it because I intend to exercise this option. I want to get to 1,000 shares with Tesla. But what I've been doing on that call is I've been doing the board man cover call as well. So I sold calls on that particular call. One of the things you got to really keep in mind with these calls is that the call that you sell on this option, you can't roll it out further than what the call that is underlying is at. And what I mean by that is I bought this 175 expiring August 16th, and you see here this 195 call that I sold on it, right? It expires on 8/16. So this is a very dangerous kind of situation to be in, because this 195 call, right? The person that bought the call, when you buy an option, you have the right, but not the obligation to exercise it, right? So that means the decision lies on the person that bought it, not you. So whoever bought this 195 is doing pretty good, and they can choose to exercise it at any moment. So the moment they exercise that, I really don't know how Robinhood treats the underlying asset. If it would force me to exercise this call, I really don't know what would happen. But what I'm waiting on is to sell this MELI put, the MELI, which is a very expensive call. I'm waiting to sell that to have enough cash to then buy the 100 shares of Tesla at 175, and then push this call out to December, much like I did with my other ones, which I pushed them out to December to 205. So this is a very good example of what happens when you get caught underwater with shares. Now, look, I'm going to hold on to them. Time to me is not an issue. When December comes, maybe I'll roll them out a year and get up to 220, 230 next year to who knows, but I'm just going to keep chipping away at them because I like the stock. I want to keep the shares, and you never know, like when you look at Tesla, hopefully there were people that on the run up didn't let go of their shares. You look at the 5-year chart. There's instances of people that rolled. The stock's at 407 and your rolls are maybe still at 300. And then look what happens. They would have been able to buy those contracts back and kept their shares. So you never know. My point is, you never know what's going to happen with the stock, right? So if you like it and you're willing to keep rolling out, keep doing it. You may be caught in a situation where they expire at a time when it's below, they're out of the money, and you're able to keep your shares and the full premium you've been accumulating over months. So it's not a bad situation to be in. All right, it's 2:52, so I'm going to keep this. I'm going to try to end this quick. This is the Palantir call that we just talked about. Sophie to me has been pretty interesting. I've had a love and hate relationship with Sophie. I was doing really good money selling $6 and $6.50 puts, really good money, while it was stuck in that kind of dead zone the past couple months. I think Sophie is going to eventually react to interest rate hikes, which is expected in September. I think if we don't get a rate hike in September, I think Sophie's going to crash. So it's just something to keep an eye on. I think it'll go back to the 650 levels, 650, 630s until there's a little bit clear confirmation of rate reductions. I bought an average of 788. I've actually reduced my position. Currently, I've got $7. I'm kind of strangling it a bit because I sold $7 calls for August 2nd. And so I sold $7 puts as well. So I'm either going to have to roll my puts down and out, or I'm going to have to roll my calls, which I'm good in either position. I win in both positions. These 650 calls, I may get those called away, not necessarily trying to hold on to those. I did this Sophie $10 call just to sell calls against it. So the Sophie is, I guess, my other horse. Tesla and Sophie have been my main horses. And then lastly, just as a kind of a quick play, something I did was, Amazon's been taking a dump lately. I suspect it's because of Jeff Bezos, disposing of a large amount of shares. Not a large amount to what he owns, obviously, but a large amount considering the float. So obviously the price gets hit, right? So I bought some Amazon leveraged shares. I bought a call option on leveraged shares. So it's going to react dramatically more to whatever the market is. So I bought a $30 call option expiring September 20th, right? So this one's obviously doing pretty good. I'm up, 11% on it, $70. And so what I did on it right away, though, is in order to kind of offset my cost on the option, right? Because I remember I paid $590. I went ahead and sold, and right now it's at $34. I went ahead and sold a $38 call for $156, right? So 590 minus 156. So now my call option is worth $430, right? But remember this, I sold this for 816. So by 816, which is pretty much 3 weeks, if it's under 38, then I keep this full amount. But if it's over 38, I have some leg room to maybe roll it up to 40. But by the time it goes to 40, I've already got a pretty good delta on my calls to whatever this one is. So it would be, if I'm getting them assigned at $30, which is what that contract I bought gives me the option of, and then go ahead and sell them at 40, which is what this call that I would roll out to would expire at. That's already a $10 delta per share. So you're talking about $1,000 without really losing, $1,000 on that small trade, which, I'll definitely take. So those are just kind of the little things I do on the side to just kind of build up my cash position. But that's pretty much it. You can see my shares here. That's kind of where I'm at. Today we have Tesla earnings. I really do think this is just kind of my look. Here's my view on Tesla, and I take a very high view opinion on it. I get Musk is controversial, and I get that he says things that, a consumer-facing CEO maybe shouldn't be saying, or the net gain benefit is not really there. But at the end of the day, Elon Musk is the greatest inventor in our lifetime. I don't think anybody even comes close to what this guy has accomplished. And there's only one company that allows you to partake financially in that guy's endeavors, and that is Tesla. No other company he owns is public. It's just Tesla. And I think what Tesla is doing as far as energy, I think what Tesla is doing as far as autonomy with self-driving cars, I think they are the closest. I think a lot of people don't know what they're talking about when they say that Waymo is ahead, or that these Chinese companies. I think the moat that Tesla has with data and with AI and with just having Elon at the helm is so incredible that you shouldn't even be looking at the short-term kind of PE. I really look at just the potential of the company and its ability to navigate through these changing times, because technology is going to change so drastically in the next 6 to 12 months that those companies that don't have the ability to pivot are going to fall behind. And you're kind of already seeing it with Apple, to be quite frank. Apple has a huge moat, but their forward-facing, kind of forward-looking innovation is not that great. And that's concerning, because that's how these big, that's how you look back at like these mega companies like IBM and Intel, which were they were at the forefront of innovation and are now these mammoths that, they have a very niche part of the market, which is what's keeping them alive, but they're not what you consider to be these innovative American companies like Tesla. So that's why during this change of technology, having a capable leader to me is the most important part. And I think Elon definitely checks that. We have earnings today. I really do sincerely think that, this morning I had a call that I had bought at 260, and I sold it this morning before Tesla kind of tanked a bit. So I got very lucky. I sold it at, let's see, what did I sell it at? I sold it at, these are my current open ones. These are my done trades here. So I sold the 260 for December 20th for $37. So 3,700. That same call right now, or rather buy, because it's the one I bought for December, 260. It's 3,280. So 3,280, 3,700. So I saved about 500, $600 just by disposing of that. I had been selling calls against it. But why did I sell it? Mainly because number one, there's always kind of a dip before Tesla earnings. It's just people taking profits, especially after this huge run up that we had. These financials, and I do agree with the sentiment that I think it's going to be kind of a splash of cold water. I don't think it's just macro environment, where with the inflation and interest rates, a lot of conflict around the world. It's not an ideal time for car companies to be breaking records. I don't think that that's expected. So I obviously do think their numbers are going to be taking a pretty big hit. I think Tesla Energy is growing exponentially, but it's not enough to move the needle on the financials. And at the end of the day, people get pretty strict with financials when things get tough. That's why I don't think a lot of credit is going to be given to them. I also don't. I do think we're going to be seeing a bit of a trickle and hopefully Tesla itemizes it out of any subscription profits from full self-driving. I think that's going to be, if that is anywhere substantial, that may cause the stock to move up. But I think on a general trend, it's not going to be anything crazy. And so because of that, I think Tesla is going to move back down to 220s, 210s before we get ready to move back to the 300s once FSD event happens and the world is made aware of what's happening. I really sincerely think that most people are just not aware of how advanced and capable FSD is. I mean, it's honestly ridiculous the amount of technology that's going into that. And I mean, if you think about it, AI computers, they're just getting started. Elon with XAI, they just started that cluster. They just turned it on like last week, So if you give that technology time to train the data that Tesla is collecting through their whole car fleet, the reliability of FSD is going to increase at such an exponential point that it already is the market leader. It's going to completely solve FSD, in my opinion. So, anyways, long story short, guys, that's pretty much it. I'm looking at the live stream. I think there's a couple people watching. If you have any questions, feel free to just, you should be able to write them there. You should be able to write any questions, any Q&As that you may have, or write them in the comment section, and I'll go ahead and definitely talk about them later. Thank you guys for watching. My whole point is to be transparent. Any questions you may have, I'm definitely going to show you my bad trades, my good trades. I'll give you my insight into how I make trades. I have an Excel sheet that I use religiously where I track all my trades. I think probably the most important part. You should be tracking your trades. You should be looking at what income you're making off your collateral or off your cost basis of shares. It's good to keep that in mind. And I'm going to be doing this maybe every week, every 2 weeks specifically. I usually trade on Mondays and Fridays to just make my trades or sell my trades or roll my trades. So I'll probably do this on Friday and maybe do some live moves. But thank you guys for watching. Appreciate all the support, and let's keep it going.